welcome to Market Domination. I'm Julie Hyman. Alexandra Canal in for Josh Lipton today. Live from our New York City headquarters, we are giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money.
And here's your headline blitz, getting you up to speed 1 hour before the closing bell rings on Wall Street.
The bull market in the States rarely goes more than 2.25 years without a big break. Well, it doesn't have to be a bear market, but certainly a big break, a multi-month pullback. Maybe it's 10%, maybe it's a little bit more than that. And you can see that if you look at the history of the S&P 500 all the way back to the 1970s. It almost never goes longer than that without a meaningful crack. And you can see the signs of it. It looks tired.
I think you're going to see over the next 6, 12, 18, 24 months, lots of people continue to, show that their models are faster and faster. As you saw in DeepSeek, you'll see that things get, cheaper and cheaper. I think it's going to be a long race. And at the end of the day, I think the largest companies in the world will probably end up winning this race.
When the threat of tariffs was used on Mexico and Canada and then back down when a border issue was agreed, the markets realized that the threat of tariffs isn't going to be just about all trade, about putting a tax on US consumers effectively. The threats of tariffs are often going to be used for foreign policy objectives. So the markets have reconsidered the inflationary impact of Trump's policy.
We got 1 hour to go until the market close. So let's take a look at the major averages here, which are not doing a heck of a lot. The Dow was off by about 122 points at just about 1/4%. The S&P 500, very little change. It would be tough for it to be less changed. It's down just a point. And the Nasdaq's down about 1/4%. It's a holiday shortened trading week, Allie. Investors kind of weighing what's to come this week. We got Fed minutes. We got a little bit of economic data. But no big catalyst coming down the pike.
No big catalyst, but what's been an interesting story for me is since the start of the year, markets have really shrugged off these quote-unquote bad headlines, right? You think about the DeepSeek sell-off earlier in January. You also had those hot CPI inflation numbers come out, and largely we're back to where we started. They were able to recover a lot of those losses. The S&P 500 is trading just around those record highs. So look, we had a bit of choppiness, but the roller coaster ride, it keeps going forward, which I think is impressive, especially considering we've been talking a lot about this broadening out of the bull market, not just so concentrated in those mega cap names.
Yeah, we're very close to that new record close again, which is around 6,118 or so, a little bit above those levels. So we keep sort of making some attempts, but not quite making it there. Some of the other things that I'm watching today, I've got an eye on oil prices, which we're seeing move higher. Some reports here, and this is a rebound, obviously, that we're seeing today, but some reports that OPEC Plus is considering once again pushing back its plans to open up supply further. And so that might be one of the reasons that we're seeing it higher today. And with that, we're seeing energy stocks leading gains. So here are the sectors in the S&P. XLE, the energy sector, up about 1.75%. Utilities and materials also gaining, and communication services lagging today.
Yeah, the demand picture for oil, that's going to be something that investors, traders are going to consistently be watching, especially as we monitor those potential tariffs. If a trade war could come, all of that good stuff. But year to date, all 11 sectors are in the green. I just had mentioned that broadening out of the rally. So not too shabby as we're about halfway through that first quarter. So we'll see if this momentum can continue.
Yeah, and one more thing I do want to point out here today is we're seeing communication services do the worst in today's session. Looking at the action again today, here's something we haven't seen in 20 sessions, right? The Meta shares falling after that 20 session winning streak for the stock. Today it's off by 3.8%, so bringing that record winning streak to an end, but we're seeing some of the other large cap tech stocks also lose some ground.
Yeah, and we have to thank Meta because it's really outperformed a lot of its Mag 7 peers, and that's lifted up some of the gains that we've seen in the S&P 500, perhaps why we're a little bit more muted today. But Meta, a great story, especially when you think about the AI future of this company. It seems to be a little more clear-cut compared to its competitors, so
at least investors seem to think so.
Breaking the winning streak, but still doing very, very well since the start of the year.
Yes, good perspective. Well, as we've been saying, stocks have been stalling out just shy of records as of late. One survey, though, shows bearishness among individual investors has reached its highest level since November of 2023. For more, let's bring in Stephen Whiting, Citi Wealth Chief Investment Strategist and Chief Economist. Hey, Stephen, it's good to see you. So it has been interesting here how we keep sort of making attempts at new highs. We don't quite get there. But it does feel like that there is an interesting sort of sentiment and action disconnect here. How are you thinking through sentiment right now?
Well, look, you mentioned earlier at the top of your program noise. There's tremendous amounts of noise. There's great concern over particular risks, policy risks. None of these things are large enough to sink the American economy or the world economy. If you just think about what reciprocal tariffs might mean, $100 billion on a near $30 trillion economy. I do think, again, for particular companies, there are pain points. There are pretty high expectations for U.S. shares. And that's why we're having trouble. 6,000 is a pretty full number. We are looking at over 22 times and pushing EPS expectations up even higher from double digits is a little tough. And this is why you're seeing markets in Europe and Latin America with double-digit gains this year. I mean, everyone hates them. Right? I've just been there and people feel like the future is over. It's just not like what you see here with the optimism. So I think, our 15 years of outperformance of US equities over other markets, I'm not trying to say that this is the 1999 moment, but it's just harder to keep raising expectations in the US.
And let's talk about some of the noise that you mentioned. You talked about tariffs a little bit. How much of a risk is a global trade war to some of the assets out there? Or do you think that's not a risk that we'll see in 2025? Perhaps it's more of a 2026 view?
It's not going to change the U.S. trade picture so much as you have to think about U.S. companies having a market cap surplus. We're now 67% of the world. Firms that do a lot of business in China have been doing really, really well. Their share prices, right? So there is risk of appointment from retaliation, the fact that we have companies that don't even have substantial businesses in some of these markets still facing some retaliation. And you're seeing in other places, it's probably going by as more of the noise channel. If you think about North America and what it would take if we were really to have 25% tariffs instead of a free trade agreement, you're likely to see, as someone said earlier on your program, this being used as a foreign policy tool. But sorting all this out is a tremendous amount of noise for markets and investors.
Well, and markets are definitely not pricing in the worst case scenario on all of this.
Absolutely
the
not.
market is not behaving as though on March 1st, 25% tariffs are going to effect on Canada and Mexico.
Well, we saw a delay of a month. You saw what happened in 2019, almost the identical set of threats. I think you're likely to see more compliance. You're likely to see that U.S. border costs shifted abroad, for example, as a policy victory. But this is a little bit of guesswork. And if you are a small manufacturing company in the auto industry, you're feeling highly uncertain right now.
So you said in your notes to us that now is the time for open minds and diversified portfolios. Where does that diversification lie? You mentioned emerging markets a little bit. Should you look overseas for opportunities?
Well, if you take a look at how far the U.S. has come, U.S. equities are worth twice as much, more than twice as much as all the other companies in the world. I could take the top 3 companies in the United States. They're worth the entirety of the markets in Asia, from Japan to China to India and everywhere in between. That's sort of extreme. Looking back, it makes some sense how we got here. Very large companies, highly innovative, growing rapidly for a long period of time, but it's a lot of good fortune. And you don't take that for granted when you see us at an all-time high, the dollar at the second highest level in history, and really beaten down sentiment everywhere else. Again, some of the emerging markets are the more vulnerable ones. They have the higher tariffs, so reciprocal tariffs can be more painful for them. But there are places where you just see some relatively dynamic growth and low expectations. Just think about low expectations. I just came from Brazil, trading at less than 7 times earnings, 7% dividend yield. Last year, a currency crushed 25% for domestic concerns. What are you seeing? Double-digit returns rebounding this year. That's not going to be necessarily long-term growth, but it shows you what can happen when everyone is focused on the same successful assets, repeating that performance.
So what sort of could change, like what catalysts are you watching for specifically this year to sort of change these paradigms further? Or do you think they sort of reassert themselves?
They may be in play already. So when we say diversification, you were mentioning earlier about all the sectors that are up. You have 8 out of 11 sectors with earnings gains. Tech was third down the row, right? So the fact that there is broadening profit gains in sectors that have relatively low confidence. Very few people expect healthcare profits to be higher in the future. They expect tech company profits to be higher in the future, or to gain share, to be even more precise on this. So when you actually go from EPS declines to gains, when you see profitable mid-sized companies go from EPS declines to gains, well, that's when you can expect performance to broaden out. It's not just going to be, they've been down a long time. Most regions of the world might have some trade sector risk, but by and large, they've gone from a lousy performance in 2023 on the profit front, to gains in 24 and into 2025. And this is not an extended rally for global markets. Then you think about the interest rate outlook. We have some of the highest interest rates in the world. And there's a lot of competition from the bond market. We should have more balance, right? If you really have something other than the highest return target for your portfolio. You don't care about liquidity, you don't care about volatility, well, then you're in a different place than investors who want to balance out immediate income and controlling risks. You can get immediate income and controlling risks in fixed income assets, and they're just a lot more competitive in terms of relative returns now.
All right, so diversification, the name of the game. Thanks, Steve.
Good
to see you. Thanks for coming in. We're just getting started here on Market Domination. Coming up, Intel stock jumping today following a report that its rivals are exploring potential deals to split the chipmaker in two. We'll speak to an analyst on the other side about what that possible move could look like. Stick around, much more Market Domination still to come.
Intel stock is jumping today following a report that its rivals Broadcom and TSMC are exploring potential deals with the chipmaker that would split it into two. Joining us now is Matt Bryson, Wedbush Securities Senior Vice President of Equity Research. So Matt, I first want to get your take on this report. A breakup is something Intel itself has considered in the past, but at this point in time, does that make sense for this company?
It certainly makes sense for investors. So I think if you look at the two different parts of Intel, you've got a chip business that is able to do 120, 130 billion in revenue and is very profitable. And then you've got a foundry business that, or fab business that can't make money and is struggling a bit. And so if they can split those pieces, the fab assets have value. The chip design business clearly has value, and so that would certainly create value for investors.
Well, I guess the question is how much value, right, Matt? Because right now we're looking at a company whose market cap is around $116, $117 billion a share, with the shares up 14% today. If you did break it up into those parts, what kind of value do you think could be unlocked?
Oh, yeah. So I think, sorry, I think I misspoke before, but I think that if I remember correctly, the chip design business does 12 billion in operating profit per year or last year. So you give that a 10x multiple, that gives you 120 billion value alone. And then it comes down to the fab side of things. I mean, they're putting, I think last year was north of 20 billion in capex, and so the asset value is probably close to 100 billion. It certainly depends on how you value those assets, but you certainly could end up a whole lot higher than what it's trading at now. And again, the chip design business alone could be valued at more than what Intel's being valued at now.
Matt, from a regulatory perspective, there's some conflicting thinking when it comes to whether or not the Trump administration would allow a foreign entity to operate Intel's factories. How likely is it that a deal like this could even cross the finish line?
Yeah, I think that's really the question. So it's in part, would the Trump administration be willing to allow a Taiwanese company to operate the largest set of fab assets in the U.S.? But then also you run into issues in terms of getting this deal across or by other regulatory authorities. So think about the fact that Intel, which has maybe 15% of total fab production out there, wasn't allowed to buy Tower Semiconductor, which has a little over 1% of the market, by China. In this case, you'd be talking about Taiwan Semi, which is over 60% of the market, having captured another 15% of the market to have 75% of the market. So could that get by China? Could that get by Europe? I don't know.
So all that said, even if it isn't that likely that this is how it plays out, right, from a regulatory perspective, what are Intel's options at this point, right? If this isn't what happens, does something have to happen in terms of a different structure for the company?
Well, I think in part the thing we don't know is the struggle for Intel has been that they haven't been able to get their fabs working or working at a competitive level with Taiwan Semi. So if their next process, 18A, is successful, if the process after that, 14A, is successful, that gets Intel working again. Having said that, if that's not the case, if their fabs continue to struggle, then I mean, that's a good question. And the big problem that Intel has is, what do you do with those fabs? Because they're losing so much money. So it's hard to break them off from the chip design business and supporting them. And so back to your question, I don't know what Intel does if Pat Gelsinger's vision of we're going to get our fabs to work doesn't come to fruition.
How involved do you think the Trump administration is going to be when it comes to Intel's future? Because on the one hand, Intel is very important to President Donald Trump if he wants to make domestic chips, right?
Yeah, I think that comes back to kind of the question around, can you get this sort of deal to work? So I would say traditionally regulators wouldn't approve this either. I think Broadcom has been speculated to be buying the chip design business. Those large deals haven't gotten past regulators. Again, like I said, China wouldn't approve this relatively small transaction with Tower Semiconductor, but it seems like everything with this administration is negotiable. So at the end of the day, getting approval from China, getting approval from European regulators, I think that's going to have to be something that's negotiated by the Trump administration. So I think at the end of the day, this deal is almost more what they have to get done than it is a question of what Intel wants to do.
Matt, obviously Intel has been seeing a huge bounce back lately, and not even on this specific report, but sort of in anticipation that something, and on speculation that something might happen. I believe you're neutral rated on it. Like, is this stuff enough of a reason to buy, or what would be?
So my struggle is going back to, can you get something like this done? And I just don't know. If you don't have the government getting involved in creating a solution, I don't know what Intel is able to do with its fabs. And so then it comes back to, can they get the business to be strong enough or organically? And that's what I've struggled with. So again, they have to get those fabs to be competitive, and we just don't know until the new products come out on their new fab processes, which is second half of this year. And until then, it looks like AMD is just taking share from them, which makes things harder and harder for them.
Yeah, it's definitely a murky situation, to say the least, Matt. But we appreciate you coming on to talk to us about all of the reports floating around out there. Thank you. Now, time for some of today's trending tickers. We start with Walgreens shares rising as a take-private deal with Sycamore Partners reportedly remains a possibility, according to CNBC here. The deal had previously been described by CNBC's David Faber as mostly dead, and now he says it is potentially
alive again.
Right? Which always reminds me of Princess Bride and mostly dead, and I don't know. So it looks like really shareholders are sort of grasping at any type of hope here.
Yeah, I mean, this is a company, the pharmacy operations, that's been under a lot of financial pressure. This burdened with debt, increased competition from online and discount players like Amazon, for example, that little company that we know of. So not a lot of cash on hand. The company suspended its quarterly dividend at the end of January, and it paid that for almost 100 years. Suspending that can't be good news. It's clear something needs to change here, but that debt story, I think, is going to make a deal a little bit more complicated. So still a lot more information that we need here.
Yeah, and the stock, as you said, the financials have been struggling. The stock is down about 50% over the past year or so. And kind of like Intel, which we were just discussing, analysts are not ready to step in here until there is more information. We've got 3 buys, 12 holds on the stock, and 3 sells.
We'll see. Certainly a company that's undergoing a lot of stress right now. Moving on to another trending ticker, shares of Archer rising as it receives FAA certification to launch its pilot training academy. The company aiming to build a pipeline of pilots in preparation for its planned commercial air taxi services. So basically this certification, it formally recognizes Archer as a regulated institution for pilot training. And if we just take a look at the stock price, it's up over 100% over the past 12 months. It's trading near the high end of its 52-week range. But Julie, you brought up an interesting point earlier this morning that it feels like a meme day in the stock market, and perhaps this is one of those trades that has just received that memification that we like to call it on Wall Street.
I mean, I don't know that this news that it got today, this FAA certification, was unexpected, right? It's another step in its quest to create this air taxi service. But given that we saw that move, and then I'm looking around and seeing some other moves of things that aren't necessarily on news, for example, if you take a look at the Wi-Fi Interactive here, here's an equal weight of some of the meme stocks that we watch. And yes, a number of them are down. And one of them, the one that's doing the worst on this board, is Robinhood, which did get a downgrade, which we're going to talk about later. But a lot of the stocks that are up on this board, Well, there's not necessarily any reason. BlackBerry, for example, which is sort of memeified at times, up 5%. There's no particular headlines on that one. Palantir, which continues to be a name that people really like. It's not a sort of pure meme because it does have a business, right? And one that is growing. But still, that stock is trending today. It's on our trending tickers page. So there's sort of some ones that it's sort of a meme vibe, if you will, today. And Archer feels like it's on that meme vibe. I mean, we're seeing like quantum computing companies pop up again. The companies that last week NVIDIA said that it was buying, the stocks that it was buying, those stocks are still trading today. Maybe it's just like a holiday shortened trading week vibe. I don't know. But we notice the memes are moving. Yeah,
the major index is not doing much, but under the hood, no pun intended, we do have some market action. So we'll continue to track all of that. But coming up, Wall Street's defense of its DEI initiatives has suddenly become a lot more complicated. We'll get you all the details when Market Domination returns. Defensive diversity, equity, and inclusion initiatives getting trickier on Wall Street as JP Morgan Chase CEO Jamie Dimon chimes in on the discussion. Yahoo Finance's David Hollard joins us now with more. And David, it's very clear that Jamie Dimon, he's not mincing words here.
Yeah, I mean, I guess it kind of remains to be seen. These comments heard from a leaked audio recording from a private meeting last week sort of raised eyebrows, given how outspoken Dimon has been about using the bank's resources to aid minority communities. Now, importantly, though, he's also recently shown a willingness to fight outside attempts to change JP Morgan's DEI policies. Like about a month ago, he actually said, bring them on when referring to conservative activists' attempts to change JP Morgan's policies. But crucially, Dimon's arguments for DEI policies have always kind of relied on them being good for the bottom line. And in this recording that we obtained last week, we heard that he was raising questions about the costs in some efforts around DEI initiatives. Dimon was not specific about whether or not they would cancel specific DEI programs. And he did also say that the bank's approach to serving Black, Hispanic, and LGBTQ communities wouldn't change. So the question really is, at this point, what is changing? And we kind of found that out on Friday when JP Morgan filed their annual report. Essentially, they scrubbed all mentioning of a diversity, equity, and inclusion in their annual report. They did keep it in one section, which was under the reputational risk category. So this is kind of showing you what's happening now with DEI and Wall Street, at least at Wall Street's biggest bank, is that it's becoming more of a defensive play. And essentially, they're trying to scrub mention and water down language. And the Wall Street Journal has also reported over the weekend that other banks, when they report their annual reports, should be doing similar measures.
Yeah, and indeed, as we know, it's gone beyond Wall Street as well, more widespread at the moment in corporate America. Thanks for keeping us posted on all of this, David. Appreciate it. Well, meantime, big banks, JP Morgan, Citi, Goldman Sachs, and Wells Fargo, they're all trading at or near records, while executives from large U.S. banks discuss with Republican lawmakers issues with debanking. Our next guest says macro headwinds have turned to tailwinds for financials. Hennessy Funds portfolio manager David Ellison joins us now with more. And David, obviously there is sort of this cultural and regulatory shift on things like DEI. There's this discussion around debanking. But meantime, these banks are creeping up to records here. So let's talk about that side of the equation first and what you think has been driving them there.
Well, I think it's the biggest thing has been the shift, in my view, the shift in rates. We had rising rates for a couple of years and then rates started to go down. Obviously, we know all that. It's all been well documented, and that has taken the pressure off the deposit costs and the mark-to-market problems that were brewing that obviously created the Silicon Valley and the other ripple effects. So, credit's not been a problem. The yield curve has obviously improved a bit. It's not as good as it, has historically been, but it's better. And I think the regulatory framework appears to be lessening. At least that's the talk. And so I think the stocks are drifting higher. But earnings are going to be up the next couple of years. They were down for 3 years in a row, and now this year they're going to be up, and they'll probably be up the next 2 or 3 years.
Has a lot of this optimism been priced into the stock at this point? If you weren't in banks, is there still time to get in? Are there opportunities ahead?
Well, I think the banking industry has been pretty dormant from a performance point of view since 2008. I've been running financial funds since the early 80s, and boy, the last 10 years have been just brutally awful. It's been a lonely vigil of nothing happening while the tech names seem to go up every day and have, multi-trillion-dollar valuations. So I think from a performance perspective, from a valuation perspective, they've been left behind, and to some degree for good reason. 2008 created this avalanche of regulatory sort of, constriction that has made them risk averse, and so the returns have been low. And they've been sensitive to rates, and the Fed has been obviously making that difficult for them. And so if that turns, I think you've got a situation where the group could finally sort of catch a bid beyond sort of the traditional banking model, and we'll see what happens. But I think the industry suffers with very low innovation, very low new product development, very little growth. Loan demand has been awful for at least half a decade. And if that all changes and reverses, I think the group can continue to go up.
Well, what would cause that to change and reverse, David? I mean, as you say, they are still paying for the sins of the financial crisis. There are some who would say they should be, right? That risk should be constrained. But do you think that is going to change? And is that the thing that is going to potentially unlock innovation?
Well, I think to some degree, all you said is right. Obviously, they over-deregulated and they created a problem, and they blew themselves up, and they were going to eat themselves in 2008, 9, 10, and the government came in and stopped it. And they said to everybody, play nice in the sandbox or else we'll get rid of you. And so they all decided to play nice and be regulated quite heavily. I think the issue I have now is, in the sense that you need to have a transformative acquisition. You need to allow the banks to generate or develop new products. You've got other industries, other companies that are getting into their businesses. And I think to some degree it's, the bigger banks have to lead the way. They can't sit on traditional banking and expect to really get the kind of multiples that even, a Hood or a Coinbase is getting. And they deserve those multiples if they can really think outside of the box and do what, in a sense, what everybody else has been doing, other industries have been forced to do or have been doing.
So David, what are some examples of that? What sort of policies or reforms do you think will ultimately be implemented that could significantly impact the earnings of these companies?
Well, I don't think it's, the earnings are important, but it's really the direction. They make earnings from a spread and they have some Wall Street income, and that's great, and it's all kind of boring. And the market has told you that's boring. They want new products, and they want innovation, they want transformative acquisitions. And so I think that's more important than growing earnings. JP Morgan, Bank of America, Citigroup, Wells Fargo, and maybe a few below that, they need to do something interesting that's going to capture the imagination of the investors and say, look, this company can actually be valuable long term and have the sort of technology equivalent of network effects and really grow the business beyond the traditional, let's make a spread, let's get some Wall Street income and call it a day. That business is great, but it's not a high multiple business anymore.
And David, just quickly to follow up on what our David Holler was talking about in terms of these DEI initiatives, if the banks are sort of unfettered by some of the DEI expectations, is that helpful or harmful? Does having a more diverse workforce, more consciously diverse workforce, help with innovation?
It's hard to know. I think DEI means has a lot of different definitions for different people in terms of, what you should do or what you shouldn't do, or how do you approach it and to what speed and aggressiveness you apply it. So I think that's outside of, I think you can have those policies and be just fine. You can not have those policies and probably be okay. The question is what kind of people you're hiring, what kind of regulatory structure is there, and are these managers willing to make these bold moves that are outside of the norm and actually, in a sense, transform the company into something that it's not now? And that's what I'm hoping for, because, boy, the traditional banking is being eaten alive by the competitors, and it is a boring business controlled by the Fed, and that's a low value added business to be in anymore these days.
David's wish for 2025, more excitement in banking, clearly. Thank you so much, David. Good to see you.
You're welcome.
Well, President Trump is set to meet this week with CEOs of big pharma companies to discuss potential reforms in the industry, including potentially the restructuring of the pharmacy benefit management business. For more, we're bringing in Prem Shah, CVS Health EVP and Group President, and Yahoo Finance Senior Health Reporter Anjali Kamlani. Prem, thank you so much for being here. I guess I would just ask, first of all, why pharmacy benefit managers still exist at this point. Why don't we just get a direct negotiation going between the pharmaceutical companies and the health insurers, which you guys own, of course, as well?
First off, thank you so much for allowing me to be here. And, look, pharmacy benefit managers, or PBMs, have been in the industry over the course of the last 30 or 40 years, and they're very effective tools in the U.S. to help drive and lower cost of drugs. And, if you think about what their role is inside of the supply chain, they work every single day to deliver and lower cost of drugs to their customers. They serve 275 million Americans, utilize a pharmacy benefit manager to administer their benefits. These include Fortune 500 companies. These include, government-sponsored insurance. It also includes all kinds of entities that really utilize the services and tools of what pharmacy benefit managers do to help lower the cost of drugs in the United States.
Prem, Anjali here. I want to talk about that because I think, to Julie's point, there have been questions about why PBMs exist in their current structure in today's world. When they first started, to your point, they're many years old, they needed to exist because that was one way that patients find out about drugs, and in exchange for favorable placing on tiers, on formularies, that is how drug companies got their drugs sold, and that would work as a mutually beneficial relationship. In a world where now the drug companies have their own relationships with telehealth platforms, we've seen Eli Lilly and Pfizer go direct to consumer. We've seen the cost plus model, which CVS has itself started to deploy. What is the reason behind your fight to prop up PBM still? And the CEO, David Joyner, now talking on earnings calls recently about needing to defend it. Why take this fight? Why stick behind this fight?
Anjali, first off, thanks for the question. And if you think about what pharmacy benefit managers do, first let me take a step back and explain to you where the problem is inside of the drug cost inside the U.S. healthcare system. So 10% of the drugs inside of the United States 10% of the drugs cost about 90% of the total pharmacy costs. These are the branded pharmaceutical agents. And so when you ask the question, Anjali, about why it is that PBMs exist, we create competition amongst branded products, and we help drive down the cost. And so if you think about what we do versus others, we're working every single day with those formularies and other mechanisms to help our clients save money. We utilize utilization management tools and other tools to do that. And if you think about the consumers that require this, you want to be able to have your employer-sponsored insurance or your health insurance to be administered at the counter so that you get the benefit of that at a low cost. So our pharmacy benefits managers also provide the avenue for payment for these products at the counter inside of the 50,000+ pharmacies in the United States of America. And lastly, I would just say on the competition piece, if you think about that 90% of the cost is coming from branded drugs, we work every single day to create competition amongst those branded pharmaceutical manufacturers. But we've also done a really good job as an industry to drive the generic conversion rate. So think about that as the percent of prescriptions that are generic versus branded. And in the US, that's over 90% of prescriptions are now generic. Those lower cost generics help our clients save money. They help our plans and the members save money. And we continue to drive the affordability at the counter. If you look at our Caremark book of business, on average, consumers pay less than $8 for every prescription that we dispense through Caremark for their members.
But Prem, on that note, on the generics, I mean, that's something that all the other platforms that I mentioned before are already offering. You're not differentiating the company that way. So that's why my question is, if you take a look at the segments that CVS operates and take a look at 2024 revenues by themselves, PBMs fall under the largest source of revenues. So when you're talking about trying to drive and convert and all the talking points on savings, that's something that's well and good for presenting the business proposition. But the reality is that patients have been feeling the pain, and that's why all these other models have been propped up. And if CVS is already pursuing a cost plus model, my question then is, aren't you kind of talking out of two sides of your mouth? Isn't it kind of an antiquated system that you're supporting by still looking at PBMs as a way to do business when other models are working and are gaining popularity right now?
Yeah, so Anjali, if you look at the prescriptions still in this country, 95+% of prescriptions are paid for by employer-sponsored or health insurance. And so if you think about your question, health insurance companies are always going to have to administer benefits. They're going to need a PBM or a benefits administrator to service these. And as the comment I made, if you think about the cost in the healthcare system, the 10% of prescriptions, the branded prescriptions that are drastically rising in cost, those are the ones that drive 90% of the cost. And PBMs are working actively to keep branded pharma in check. And, we're committed to standing up to big pharma. If you look at what just happened in January of this year, there was about $21 billion of list price increases that branded pharma put into the system. Our job is to help mitigate that and minimize that for our customers. And so, as you think about what some of these other players are doing, they're not solving the cost of branded drugs. We are in the middle of that. We're creating the competition. We're driving the cost of some of those products down so that we can make a more affordable healthcare system that members can receive the benefits from.
So basically what you're saying is without PBMs, let's just say that PBMs just cease to exist tomorrow. Drug companies are going to run away drug prices, even though the political climate right now is focused on drug prices and is looking for ways to bring down costs, not just by controlling the costs from the drug makers themselves, but also with the PBMs. Because if you say that you're holding them to account, they also say to counter that they have to increase artificially the prices to include the rebates. So it's kind of a vicious cycle that only patients are basically paying the price for at the end of the day.
So from my perspective, at the end of the day, we don't set the list price, nor do we, determine any of the price increases
I'm not
that
saying that you
manufacturers
do.
did. Yeah, but in the middle of what just happened in January, you saw branded pharmaceutical manufacturers take list price increases in excess of CPI across the board, and that's what's yielding that $21 billion of incremental list price increases. So, from my perspective, you have to figure out how we're going to make medicines more affordable in this country. The United States, basically is paying 4 times more than other developed countries for these branded pharmaceuticals. We have to create an environment in which, if you don't get cross-subsidized, and look, at the end of the day, the innovation that comes from these new pharmaceuticals, they're important, but the U.S. can't be the only ones left paying for the innovation that comes from these. And that's one of the things that we're focused on is how do we continue to, one, create the competition and lower the price of these drugs. And we would absolutely accept, lower list prices any day of the week, Anjali. At the end of the day, we serve our customers, and our focus is to lower the drug cost for Americans and all the consumers that we use and all the customers that utilize our pharmacy benefits business.
Prem, thanks a lot for joining us. Appreciate it.
Thank you.
Well, it could indeed be a rocky year for pharmacy benefit managers as the Trump administration sets its sights on so-called PBM middlemen. Joining us now for more, Yahoo Finance senior reporter Anjali Kamlani with us. So, we've been talking about this, and clearly the Trump administration and, by the way, the Biden administration before them were focusing on these middlemen. So what happens now?
It has been an ongoing fight, and that's why it's so interesting right now how it's sort of coming back to the fore. And I think you see a political climate in which something can really happen, or is trying to really happen this time. And what that ends up looking like, whether it is legislation that controls how PBMs operate or basically wipes them out, or if it's legislation that controls prices for drugs, more so than what the IRA currently does. I mean, we saw Pharma, the biggest lobbying firm, just come out with their 2025 policy agenda today ahead of what was supposed to be a meeting with Trump, and saying that part of it is to focus on PBMs. So this sort of finger pointing has been going on for some time, saying, quote, put patients before PBM profits by sharing negotiated savings directly with the patients and holding PBMs and health plans accountable for limiting patient choices. And that kind of encapsulates what I was trying to speak with Prem about, which was, at the end of the day, the negotiation that's happening is two companies trying to reserve their profits. And at the end of the day, patients don't really get a chance to benefit from that. So how does that finally come about? And what does the administration do to then help deflect that and get people out of bankruptcy and out of pressures of missing, their prescriptions? That's the question on the table.
Yeah, that was going to be my question. Has the GOP, have they basically hinted at anything that they will do moving forward, or any policies that could come into play? Because there's been investigations and we've seen anti-competitive practices come out for these PBMs. What is the Republican side of the equation? What have they said?
It's a bipartisan issue, and that's the part of it that's the most interesting. So what can they do beyond putting more pressure, more rules in place, kind of like what we saw come out of the IRA with Medicare negotiating prices? Can that trickle down, and can the private sector do more in that space? There's a statistic, we just heard it, about how most Americans get their drugs through their employers, and therefore these employers are then responsible for choosing the plans and choosing the models. If more and more shift over, it becomes sort of this domino effect where more and more people are picking the models that don't feed into the current system. And so that's where the conversations have been going. That's where we get to figure out, can Congress in fact hold them to account? Can they restructure? Can they pull them apart? Can they take PBMs out of these larger company verticals so that they don't have that leverage that they're currently using to negotiate prices?
We'll have to wait and see. Anjali Kamlani, I'm sure you'll be tracking all of it for us. Appreciate your time. Stick around, much more market domination still to come. We'll be right back. While many of the biggest tech stocks have stumbled out of the gates in 2025, some of the sector's legacy names haven't had the same issues. Companies like Cisco, IBM, and Oracle are outperforming so far this year, signaling that they too can be winners in the crucial growth area of artificial intelligence. Joining us now to help navigate the cloud space is Siddhi Panigrahi, Mizuho America's managing director. And Siddhi, like we were just saying, we've seen a lot of these more old school names in the cloud business outperform a lot of those Mag 7 players kick off the year. So what's been the catalyst for this growth? Is it all AI driven? And perhaps the bigger question is, can it continue?
Yeah, well, thanks for having me here. And you raise a good point in terms of traditional legacy companies, software companies, specifically Oracle. I'll highlight here. If you look at Oracle growth, last decade, like 2012 to 2022, it was only 2% CAGR. Nobody ever believed that Oracle can, deliver double-digit growth. It's partly fueled by AI. I won't say it's all about AI. If you look at Oracle, it's a large, they have the end-to-end technology stack. But what Oracle has done, if you think of we are at the cusp of AI revolution, Oracle has built up their tech stack ready for AI. But if you compare that to CloudWave, a decade ago, they didn't have anything. I mean, they did have something, but not enough. But this time, they have everything for now to be the winner here, and that's kind of driving incremental growth. Of course, other parties, that's application business, which also creates data. Oracle database which stores data, and now they have infrastructure, everything ready for enterprise to partner with Oracle.
And so when you look at the outlook for 2025, do you see Oracle as the big winner or as one of the big winners in your coverage, or do you think investors should be looking elsewhere, especially since Oracle has already gained a bunch?
Look, I think going back to that double-digit revenue, investors kind of, don't believe that Oracle can deliver double-digit growth. And this fiscal Q4, which will be in the end of May end, that is where the first time they will deliver double-digit growth after, I don't know, so many years. And then next year, they have already hinted or guided for fiscal 26, which kind of, from May fiscal year end, they are going to deliver 14% growth and operating margin 40% plus. Certainly, this is kind of a new era for Oracle. If I compare to last decade or so, Oracle was like low single-digit growth. Now it's coming to mid-teens kind of growth. Certainly, it's a new era, and I think investors at this point still, I would say it's underweight at this point, Oracle.
What other companies do you think are best positioned in this environment?
I mean, definitely, start with if you think the AI is the key driver at this point. We have seen only on the infrastructure side, mostly semi-cheap companies, they have benefited, like you see NVIDIA. Next, I think is what we have started seeing is a hyperscaler, and who is going to basically host all this, provide you the AI infrastructure. And Oracle is one of them, which help you train AI model. That's exactly now they are benefiting. A lot of AI companies now leveraging Oracle to train their model. But next comes inferencing, next comes enterprise adoption, which we have not seen that. So after that, we'll see the companies, those who owns data, going to benefit from that. So a lot of SaaS companies, like cloud application companies who owns data, they are the next beneficiary of that. And subsequently, you will see the companies who can, leverage that data and application layer. That's where ultimately, consumption happen. All the capacity build out will always is going to be monetized at the application layer. So subsequently, we'll see that. So in my space, a lot of companies, applications companies are there, including HubSpot, even contact centers companies are there, like, Five9 and NICE. They're all kind of going to benefit in the AI.
And Zoom caught my eye, too, in your coverage as one that you like for this year. Zoom's kind of been bumping along there. What do you think are going to be the big catalysts for the company?
That's a great point. Look, Zoom, which has been growing, 300% at some point during COVID, post-COVID, last 2-3 years, we saw the growth decelerated. And last couple of years, even growth came down to low single-digit growth. And that's mainly because they are seeing some kind of downsell on their core video business. That is what putting the pressure. But most of the enterprise contracts are 3 years. So we think from here, the impact, negative impact from the downsell during contract renewal will be minimum. But then we will see subsequently what's going to drive them is that they are adding more innovation. For example, phone has been driving growth. Next will be contact center, cloud contact center. They're emerging vendor in the cloud contact center space. Then their workflow there. They are adding AI. The Zoom Assist is another layer. So when you think the core video, impact from the downsell in minimizing, then you are layering growth from all the innovation. You'll see Zoom starts growing from low single digit to mid single digit growth, then to high single digit growth, and the margin is somewhere between mid to high 30%. And Zoom right now trading at 10 times free cash flow. We think that's a value stock in software. And when you see the growth accelerating with such a high margin, you'll start seeing the stock going to work.
Citi, thanks so much. Appreciate it.
Thank you. Thanks for having me.
While we're wrapping up today's market domination, don't go anywhere. We've got you covered with all the action following the closing bell. Stay tuned for Market Domination Overtime.
There's the closing bell on Wall Street, and now it's Market Domination Overtime. Jared Blicker going to be along in a second to get us up to speed on the action from today's session. I'm going to start with where the major averages ended the session, all in the green by just a hair, just a whisker. The Dow up only about 10 points, 100th of 1% here. And really we saw the major averages trade in a pretty tight range today and a little changed range today. Not a lot of macro catalysts, not a lot of new news on the tariff front, for example. We'll get Fed minutes tomorrow, but nothing enough to really push things in a very significant direction today. We had the same case with the S&P 500 rather. Finishing a higher, sort of taking a leg up at the end of the day, but still only up 0.25%. And the Nasdaq also peaking very barely into the green here, setting up for the rest of the week. And of course, we had off yesterday on the market. So the first trading day of the week here, kind of a little changed result. Jared, what are you seeing under the surface here?
Well, we got to talk about Meta. That will happen in a minute. Yes, pulled out a green close just barely in the major indices, but not a lot happening today, at least at the surface level. Here's the 10-year T-note yield. That was up 7 basis points. That's notable. U.S. dollar index also up a little bit, but nothing to write home about. So we'll just put that in the back pocket. And then we will look at the sector action. And today we have energy. That held out in the lead today, followed by materials. Then we got utilities, tech, industrials, financials. That is the top row there. So energy, number one. And then in the red, we have communication services, consumer discretionary, and then healthcare. All three of those in the red. Let's turn it over to the Nasdaq. I mentioned Meta down 2.76%. Worst day in several weeks. It was pretty close to the close. Worst day since December, but I think it managed to eke out some gains into the close, at least off of those lows, so probably not as bad as that. But it was supposed to be day 21 today, and in fact, it was up 20 days in a row, but that didn't make 21. It was a $66 billion market cap loss. That sounds like a lot, but in the grand scheme of things, I think that ranked 250 when I ran it through the Mag 7 loss engine, and that was number one was about 600 billion, and that was a few weeks ago with DeepSeek. Nvidia, for its part, was up 0.4% today. It's inching closer to its record high, but not quite there just yet. I think it's about 5% off or so. And you can see, aside from some red and some of the bigger issues here, it was mostly a green day in the indices. And I got to show you what's going on with China. Going to do a deeper dive in that with Josh in about, or excuse me, with you, Julie, in about 30 minutes. We have Pinduoduo up 3%, Baba up almost 2%, and some losses as well. But the juggernaut of China really picking up here recently. Also tech, unprofitable tech, that didn't fare as well today. I'll turn it over to you guys. Allie?
Jerry Blickery, thank you so much. Well, the market kicking off a shortened trading week with muted moves. The S&P 500 closing at a new all-time high, though, but it doesn't tell the whole story of what's happening below the surface. Taking a closer look at index volatility, when you compare it to the dispersion index, which focuses on individual stocks, it shows them trending in opposite directions. Joining us now is Ryan Dietrich. He is Chief Market Strategist at the Carson Group. So, Ryan, what do you make of that interesting trading action? We were talking this morning about how the market, it's a bit of a paddling duck market, where it's calm right on the surface, but then underneath, there's some chaos brewing.
Well, that's right. Thanks for having me back, and happy new all-time highs for the S&P 500. One of the more boring all-time highs I think we've seen in a long time. I mean, it's interesting because, yes, we're hitting all-time highs, and we're up 20% 2 years in a row. Then we look at, and Jared just shared some of these numbers here. On the year, all 11 sectors are higher on the S&P 500. 7, at least as of Friday. I don't know today's data, but as of Friday, 7 groups are actually outperforming the S&P 500. So I think what's interesting is we look at these sentiment polls, and people are a little leery. Believe me, the scary headlines. We had the big drop in tech a couple weeks ago on AI concerns, so the sentiment's a little dour because people are probably a little overweight technology. But I think to put a bow on this, the reality is under the surface that duck might be pedaling pretty fast, but it's a really strong bull market. It still looks healthy to us. Maybe you're due for a little consolidation. That's okay. But to see the broad participation that's taking place, it's a great sign. I mean, last thing on this, the lifeblood of a bull market is to pass the baton around, right? And we're seeing that. We're seeing that baton being passed around. There's a lot of leadership. There's a lot of positives still out there.
But it doesn't feel like it, right? Like, am I wrong in thinking, you said it today, this was one of the more boring records that we've seen. I was looking at the AAII sentiment, which bearishness highest since November 2023. And I know that can be a contrary indicator, Ryan, but it feels kind of meh right now to be seeing these all-time highs. Does that matter?
Well, I guess to someone, if they're investing, it maybe doesn't matter as much because, hey, all-time highs are all-time highs. But I'll build on that. Just about an hour ago, one of our Carson advisors reached out to me. So they've got clients that see the headlines. They see Trump might do this, or tariffs might do that, or taxes here and Fed there. And the headline risk is real. We're not ignoring the headline risk. A couple Mondays in a row, we know what happened with those big down days. But then you look back and we're earnings season, like you guys have been talking about all day. Earnings are really strong, all-time highs. But here's a really interesting one for you. During this earnings season, 8 of 11 sectors have seen profit margins also increasing. So you got strong profit margins, strong earnings, strong revenue. I mean, we can get more in the weeds of it, but that's why we're hitting all-time highs, and the headline risk is there, but it's nice and slow and almost kind of boring at these big blasts, like you said, Julie, of volatility on some down days, on some scary headlines. But, surprises in a bull market happen to the upside. I learned that a long time ago in my career. We're in a bull market, so maybe we shouldn't be that surprised. We keep chucking higher here.
You mentioned sectors, and year to date, all 11 sectors are in the green. Finally, we have this broadening trade happening, but it's still a very concentrated stock market. Valuations, particularly in tech, are still very high. At what point does that become a problem?
Well, I think a great question there. I mean, I think for tech, it maybe has become a problem. I mean, people don't realize this, I don't think. Last year, tech underperformed the S&P 500, not by a lot, just by a little bit. So far this year, tech once again is underperforming the S&P 500, but because that's where the pricey stocks are now. That's where a lot of growth is coming from. Let's be very clear. But how'd the Mag 7 do on the whole with earnings, right? They had tons of money, they made money, but the reactions were weak, right? So the bar was awfully high, but that's where, again, this rotation trade with financials doing well, with industrials. I know small and mid caps can be a dirty word sometimes, but they're starting to do very well. And just globally, right? We like the U.S. more than the rest of the globe. We've been saying that for 2 years. But all of a sudden, like Jared shared, I mean, you've got China coming back and Europe is really bouncing back. I mean, this broadening out theme is not just a U.S. thing. It is a global theme. And for diversified portfolios, those investors out there that have stayed tried and true to diversifying and rebalancing, you're really being rewarded because, again, tech might be coming back relative. That's not the end of the world. There's other groups that are doing well, and that's how bull markets work.
It's interesting that you bring up international stocks, too, because we were talking to Stephen Whiting from Citi at the top of the show, and he's not the first person to say this, nor are you. This has been this growing drumbeat lately that people should be looking outside the United States. But then how should people think about the tariff risk, the trade war risk, which we're thinking about a lot here, but obviously there could be a big effect elsewhere also?
No, you're right. And again, we have some international exposure. We're still over at U.S. But I think the key concept here is the U.S. dollar. If the U.S. dollar breaks above the recent highs we had earlier this year, that's kind of all bets are off. The tariff concerns, whatever else is out there, the monster under the bed could be coming. But I know the dollar up a little bit today, but last week the dollar was down pretty big on the improving PPI data. We're of the camp, we're bullish, yes, over at equities, yes. We don't think there's going to be one cut this year. We think it's going to be more like 2 or 3. We think inflation is going to continue to improve, allow for the Fed to cut a little bit more than being priced in. That could allow that U.S. dollar to go lower. And let's be honest, look at history. A lower dollar is good for risk assets, but it's actually a little bit better for international stocks as well. A group that, again, we're underweight. We'd be fine if they go up, but we still think there's a lot of opportunity. One final thing to add to this, international small caps, mid caps, they're all kind of the same family. If we see some outperformance in those areas, we think small and mid caps also should do very well from the United States in the U.S. here, and we like those areas as well.
And I want to pick up on your projection of interest rate cuts between 2 to 3 times this year. Obviously, that's ahead of consensus, and you believe that we will continue to see a deceleration on the inflation side. But what about on the growth side of the story? Do you think tariffs will weigh on growth? Do you think we could see a deterioration in the U.S. economy or in the jobs market that could potentially force the Fed to cut?
Great question. If we get massive tariffs, absolutely. It absolutely could do that. But we're not seeing that yet. I mean, I know the retail sales data that came out last month was bad, but just go outside. It's really cold outside. I mean, we still see a strong labor market. We still see a strong job market. Productivity. What did we see, I think, 2 weeks ago now? A lot of jobs were revised lower, but GDP was actually revised higher. What's that tell us? Strong productivity. You go back and look in the history books, years with strong productivity tend to have better economic growth than expected, and usually the stock market do really well. We've seen that for the last really 6 quarters now, strong productivity. So that's a big theme we have on the Carson team. Strong productivity is going to lead to this bull market continuing to be stronger. And maybe to get specific to your question, there's cracks out there with the economy. Yes, the higher interest rates clearly are hurting the housing market. Manufacturing starting to show a pulse finally after a while. But the consumer, I know, again, one bad data piece with the retail sales, but I think there was some issues there. If we see more than one, then I'll be worried. But the consumer is still pretty darn strong in our opinion.
Ryan, good to see you. Thank you.
Thank you.
Well, Meta shares closing lower today, meaning the win streak has come to an end. The stock closed higher for 20 consecutive days before snapping the streak today, down about 2.75%. No particular catalyst that I could see, Allie, that ended it.
But
then again, there wasn't really a catalyst necessarily that kept it going for 20 days.
Yeah, Jared Blickery highlighted a few interesting stats. The worst day since December 18th, which was a Fed day. $66 billion market cap drop ranks about 250 in all-time Mag 7 losses. So this just goes to show how much of a tear this company has been on since really the inauguration, I would say at this point. I remember who was at the inauguration, Mark Zuckerberg. Meta, the sole performer of the Mag 7 relative to the benchmark S&P. There seems to be this optimism around its AI strategy, maybe a clearer picture there. But I do wonder what really will be the future catalyst for this company, because we've seen them experiment with things outside of their wheelhouse before, Reality Labs, the metaverse, all that didn't necessarily pan out. Will that be a different story this time around when we think about the AI narrative and what a lot of these other hyperscalers are doing?
Yeah, especially considering how much that they are all spending this year. Meta shares, by the way, up about 22% so far this year. As you said, it's the only of the Mag 7 to outperform the S&P 500. Let's get to some earnings results here. Bumble, the online dating company, out with its latest earnings reports. The shares dropping a quick 12% or so after the revenue outlook looks like is missing what analysts had been anticipating. So Bumble coming out here said that revenue was $261.6 million. That was ahead of estimates. EBITDA for the fourth quarter also coming out ahead of estimates on an adjusted basis, $72.5 million for that. But if you look at the company's first quarter outlook, it says it will make at most $248 million in revenue. That's short of the more than $257 million that analysts had been anticipating. And in the first quarter, it says its adjusted EBITDA will again be at most $63 million, whereas analysts on average had been looking for a little over $69 million. So the outlook appears to be what is sending those shares down.
Yeah, we've seen that with a lot of companies, right? If you miss on outlook, if you miss on that forecast, that's going to be, a punishment to the stock price. I'm curious on the earnings call and digging through the earnings release, what they're attributing that miss to. We've been hearing from a lot of companies that a stronger dollar, if they're more exposed overseas, that could potentially be weighing on the outlook. But Bumble, it's an interesting story, right? They introduced that Premium Plus subscription tier a couple years ago that was expected to support revenue growth, and to that point, paid subscribers did meet estimates in the quarter. But from an analyst perspective, it seems like a lot of folks are on the sidelines. Only 4 buys, 1 sell, but 16 holds. So perhaps more that they want to see from this company.
Yeah, and the shares are down 40% over the past year here. So we'll get some more details on the call, presumably about, as you said, what's behind that outlook. But the company's current CEO, Lydia Jones, talking about Whitney Wolfe Herd coming back to the company, and also talking about a product roadmap for the year ahead that should, hopefully for them, improve the performance.
Yeah, shares right now, escalating losses, down about 17%. Stick around, much more market domination overtime coming right up. The Trump administration has said it will keep using guidelines adopted by the Biden administration to review proposed corporate mergers. Yahoo Finance's Alexis Keenan joins us now with more. Alexis, it's not often that you hear the Trump admin is keeping something from Biden.
Yeah, they're going to keep it. And this came in a post from FTC Chair Andrew Ferguson saying he told his staff that these guidelines from 2003, that's when they were written and accepted. They're joint guidelines, FTC, DOJ, and it's guidelines for how they evaluate M&A activity in the United States, right? So this is Ferguson saying here that that is important. It's going to provide a framework for the FTC and DOJ's merger review analysis. And he said it's important for stability, that this is building on prior law, it's building on the prior guidelines. And so kind of a surprise, but on the other hand, you had this kind of wait and see kind of from legal experts, look at what the FTC was going to do, because certainly the Trump administration was pretty aggressive in M&A enforcement compared to Biden. I think that it sometimes can seem like because Lina Khan was chairing the FTC before Trump's administration, that there was some ultra aggressive push. There was in some respects, but when you take a look at the numbers, you have in the first, and the numbers don't shake out with perfect years with perfect data. However, when we did an analysis at Yahoo Finance back in November, we found that the first 3 years of the Trump administration had 118 M&A challenges versus the first 3 years into Biden's had 108. Doesn't change that Biden had a record-setting year in 2022 with 50 challenges brought, but it just gives some perspective there. So why are we not a little bit surprised that these new guidelines are being continued on? Well, you had some antitrust experts saying that they expected this pressure. For one, you had Trump tweeting about it on his Truth Social after the election, saying that big tech had run wild for years, that he was proud to have enforced antitrust in his first term, and he wanted to continue doing that. And also, if you look at the changes, they're pretty significant, though it's really about the way that mergers are looked at and what the thresholds are for the agencies to even decide to bring a challenge. One big thing is the way that the thresholds are balanced for presuming a merger is unlawful. That threshold was lowered. And also, what's new in there is an actual percentage figure where the agency, the FTC, for example, will look at a combined merger and say, well, if it would sweep up a 30% market share once those two firms were combined, then we're going to presume that that is anti-competitive and we're going to take a harsher look. Also, things like considering how the labor market will be impacted, that too now can be considered along with a host of other changes. So this is Ferguson stepping out and saying, well, this is more of this could be expected. But again, maybe a little murky. He said it's a framework and these are discretionary rules. They are not legally binding. So take it.
So they have some wiggle room, in other words. But it is fascinating considering how many people we've had coming on the show saying that the regulatory environment will unlock more M&A activity, maybe announcements, but then we'll see what happens at the regulatory level.
Yeah, and you had Trump already going after the HP deal for Juniper Networks. So right out of the box, he was showing some aggressive enforcement there.
See. Thanks, Alexis. Appreciate it. Well, breaking news, a federal judge denying a bid to block Elon Musk and Doge from accessing systems at several federal agencies. This coming as Musk says he wants to root out fraud at the Social Security Administration, raising concerns about Trump appointees gaining access to sensitive data. Washington correspondent Ben Warshgall and senior columnist Rick Newman join us now. And I was just glancing over the judge's ruling on this, where he basically said irreparable harm has not been done. What do we know? I guess let's start here with Social Security, Ben, and what Elon Musk has been doing inside that agency.
Yeah, so the Social Security piece of this is the kind of latest move from Elon Musk and his Doge team to kind of go agency by agency and access really sensitive data. They started at Treasury, the IRS, the Labor Department have been sort of precursors to this, and then Social Security was confirmed over the weekend. What it led to was the acting head of Social Security to leave the agency and be replaced by another career official while Trump's pick kind of works his way through the Senate confirmation process. But it sort of gets to this harm question of Musk having access to this data, and there haven't been any delays in payments or anything like that so far, but it sort of raised a lot of alarm bells here in Washington on sort of what he wants to do with this and whether he really needs this access to do what he wants to in terms of rooting out waste and fraud.
And Rick Newman, I want to bring you into the equation here because you have a new column out about how Musk could fix Social Security if he wanted to. So what are the details there?
Well, Social Security needs some work. It's not in terrible shape. Medicare is a thornier problem. That's the healthcare program for retirees. But basically, more money is now going out of Medicare in benefits than is coming in. I mean, we just kind of have a demographic problem there that needs to be addressed. I mean, this gets headlines every year when the trustees of the program put out this report. It's supposed to, the trust fund is supposed to run out of money around 2033. So that doesn't mean all benefits will be canceled, but it means that there's no surplus funding. So it's just going to get funded as the money comes in. And that would mean about a 20% cut in benefits for everybody who's enrolled in that program. 2033 is not a million years from now. That's 8 years from now, and that could get worse if there's a recession. So that needs to be addressed, or people are not going to get their full Social Security benefits. Elon Musk could rally some support to address that problem. That does not seem to be what he's doing. He's going around looking for fraud. I'm sure there is a little bit of fraud. I mean, news to Elon Musk and everybody else. The Inspector General at the Social Security Agency does audit that agency regularly, and they say improper payments account for something like 0.8% of all the money that goes out. So there is some fraud there. It's not huge. It's probably less than at Musk's own companies, but Musk is looking for much bigger numbers. So that's what people are so concerned about.
And another headline that crossed today is the Trump administration planning to cut 40% of Federal Housing Administration staff. The FHA is among one of the largest mortgage insurers in the world. And we've been talking a lot about DOGE and a lot of the government cuts that we've been seeing. So Ben, what do you make of that? And what's been the word on Wall Street when it comes to what DOGE has been doing?
Well, 40%, I mean, sounds small to me considering some of his other cuts. The other number you hear about the Consumer Financial Protection Bureau is 95%. They're trying to cut that. My point here is that they are trying to kind of do deep cuts across it, from mortgages to consumer protection to potentially the IRS and other agencies that they're going through one by one. So yeah, I think the reaction here is that these are deep cuts they're aiming for. The kind of judge's ruling and the legal challenges that we started this segment with, I think, point to the question of how far they're going to be able to go.
Well, and on that question, right, so this judge ruled this, but there are multiple challenges, right, Rick, to, and Ben, to what's going on. So do we even know how many legal challenges there are at this point? And even though this one didn't succeed, presumably another one could have a different outcome with a different judge, I guess?
Well, Julie, I think you've said that the judge said there's no evidence of harm yet. And I think that's what everybody's waiting for, to see some evidence of harm. I think it's inevitable there is going to be evidence of harm at some point. Probably if you're a federal official who got laid off, you feel harmed. But, I mean, the most important question here is whether some guy, the so-called senior advisor to the president, an unelected person, can just go around canceling funding that Congress has legislatively approved. I mean, Congress is the part of the government that says, here's what gets funded, here's the amount, here's more or less how the money should be spent. And it's the executive branch that just executes what the legislative branch tells it to do. So what Musk and Trump are doing is, I mean, at some point they are clearly going to be basically abrogating the responsibility of Congress. And that's going to be what this really hinges on. Can they just go agency by agency and say, Congress said to spend this money, but we're not going to do it? That's the fundamental thing. I have no idea how it's going to happen, but it's a giant experiment in how our government works.
It is. We'll see how that experiment turns out. Ben and Rick, thank you very much. Appreciate it.
Talk to you later.
And by the way, you can scan the QR code below to catch Ben and Rick every week on their podcast, Capital Gains. They talk about all this kind of stuff in much more detail. That airs Fridays at noon Eastern. It is time now for What to Watch Wednesday, February 19th. Let's start off on the earnings front. We'll be getting reports from Etsy, Conagra, and Carvana. Etsy announcing results for the fourth quarter before the opening bell, and analysts expect the e-commerce company will face consumer spending headwinds despite efforts to expand its buyer base.
And taking a look at the Fed, some more Fed commentary coming tomorrow from Fed Vice Chair Philip Jefferson. This coming after comments earlier today from San Francisco Fed President Mary Daly. Daly saying that Fed policy should be restrictive until inflation falls. Also coming out in the afternoon are the minutes from January's FOMC meeting. That gives us more insight into the Fed's decision to hold interest rates steady last month.
And moving over to housing, we'll be getting some fresh housing data in the morning with housing starts and building permits. Economists forecast starts will drop compared to last month to an annual pace of 1.39 million and permits to decline to 1.46 million.
That'll do it for today's Market Domination Overtime. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell.
But don't go anywhere. On the other side of the break, it's Asking for a Trend. I've got you covered for the next half hour with the latest and greatest market-moving stories so you can get ahead of the themes affecting your money. Stay tuned. Hello and welcome to Asking for a Trend. I'm Julie Hyman, and for the next half hour, we're breaking down the trends of today that'll move stocks tomorrow. There's a lot to keep track of, so we're focusing on what you need to know to get ahead of the curve. Here's some of the trends that we're going to be diving into. A slow day for markets, with each of the major indices rallying into the green just before the close. We'll dive into the rest of today's market trends. Then President Trump's newest trade war has executives concerned that supply chain disruptions will get worse before they get better. We'll explore the results of Rapid Ratings' annual risk survey. Plus, Formula One racing celebrates its 75th anniversary this year. We'll hear from one of its newest drivers. Rapid Ratings releasing a new report surveying executives and experts about the global supply chain in 2025. And according to the report, a majority thinks supply chain disruptions will get worse before they get better. For more, we're bringing in James Gellert, Executive Chairman of Rapid Ratings. James, it's good to see you. So I guess, first of all, we should say that supply chain disruptions are ranking among the highest risks for 2025 in the eyes of the folks who took your survey?
Yeah, absolutely, Julian. It's good to be with you again. There's no question that supply chain has been on everyone's minds, and certainly every company with any kind of global footprint, whether they're buying from or selling to outside of the U.S. But what we found really interesting in our survey this year is that when asked to rank the biggest risks that people saw, they listed geopolitical risk, tariffs, and economic unrest as the top three. And that's particularly interesting in the light of supply chain over the last probably 5 to 7 years, where you would have always seen cybersecurity risk as being one of the top two. So the fact that that has sort of slid down, it's now at number 4, and these other aspects, which are really all about trying to understand the challenges of the business environment and the cost base of companies and suppliers due to tariffs, interest rates, inflation, and so forth. All of these are on everyone's minds.
Well, and in the case of something like cybersecurity, you hire a cybersecurity firm, right? And I mean, you don't know where the threats are coming from, and it doesn't mean they're all going to be managed, but there is a remedy. In the case of the supply chain disruptions, nobody knows what's coming. So how are these companies modeling and managing that risk?
Well, every major, but let's just say the Fortune 1000. The Fortune 1000 have supply bases that span from domestic to international companies. And interestingly, about 75% of all of those companies' supply chains are made up of private companies. That may not be by spend, but it could be by criticality. So companies that have a big impact on the reputation or revenue disruption or the ability for a company to function well and properly. And managing the risks in those businesses often comes down to focusing on the financial health of them, because the financial health of those suppliers is what drives their ability to manage the risks like cybersecurity risk, or allows them to be a good partner in innovation and product development and the delivery of quality products without faults and on time. And all of these are very important historically in supply chain, and even more now. But when you start to throw on the risks of disruption to those suppliers from tariffs and high rates and continued inflation, you start to have these weaknesses that build up in supply chain. So the Fortune 1000 are trying to get ever more mature and sophisticated in how they manage those risks and how they look at each one of those suppliers to make sure they've got the most resilient supply chains possible.
Well, and then in turn, James, it's your job to look at these companies and see which of them is most at risk. You know, they're assessing the risks, and then you're assessing their risk level as well. So from your work, what have you found in terms of, are there particular industries, are there particular geographies? What areas do you think could potentially be most at risk from these types of disruptions?
Well, interestingly, with the risk of tariffs and counter tariffs and line item tariffs in particular, you've got the challenge that every industry is at risk. And we've seen, and through the survey, we found 81% of companies said that they have had a supply chain disruption in the last 2 years. And 30% of those disruptions cost their companies $5 million or more. And our clients span over 25 industries and are all global. So the companies that are being affected by all of these economic challenges and geopolitical challenges are really very widespread. It's too early to see if there's going to be a winning industry. There certainly are some countries that are seeing an upsurge in the reshoring of business from, let's say, China, where clearly there's a tariff interest by the current administration, to countries like, say, Vietnam.
Right.
But even then, there's the risk that that more tariffs get put on goods that come from China through another country. So no one is yet saying that there are winners and losers here. And generally speaking, in a trade war, there are no winners. There are just degrees of losers.
Well, speaking of degrees of losers, just quickly here, you pointed out to us that bankruptcy rates climbed last year. Do you expect them to climb further this year as a result of all of this?
I do. I think we'll continue to see them increase globally, and we'll also continue to see restructurings increase. Last year we had a 2-to-1 restructurings to bankruptcy rates, usually about 1-to-1. So the fact that more companies are proactively engaging with those who have lent them money is a pretty interesting sign. But you've got to keep in mind that we're coming off of still, a decade or more than a decade of very cheap and relatively easy money for most companies to borrow and paper over problems that they may have operationally. And we've seen in our financial health ratings a significant decline, particularly in private and middle market companies that have been squeezed from operational standpoints and from cost of capital, cost of labor, cost of goods. And all of those things ultimately add up to a lot of stress in a lot of these companies that need to be identified in one's supply chains to make sure that the end downstream Fortune 1000 companies remain strong and resilient.
James, thanks a lot for your perspective and for sharing those survey results. Appreciate it.
Thanks, Julie.
We've got some breaking news now from billionaire investor Bill Ackman, the CEO of Pershing Square Capital Management, announcing on X he is submitting a proposal to Howard Hughes Holdings to acquire 10 million newly issued shares of the company at $90 per share. And he's raising a previous bid made in January, which was $85 a share. This is an effort to build what Ackman calls a modern-day Berkshire Hathaway. And if the transaction goes through, Pershing Square will own 48% of the Texas-based real estate developer. Ackman says he'll become chairman and CEO of Howard Hughes if the deal goes through. Shares of Howard Hughes, they did spike ahead of the close on speculation that this would be the target here. They were up by 7% during the regular session. Now that it is confirmed, they are falling by some 5%. Well, U.S. stocks closing higher with the S&P 500 rising to a fresh record close. Yahoo Finance's Jared Blick rejoined us now with the trading day takeaways. What Ryan Dietrich called earlier a boring record.
It was. You look at the price action today, it looks like the indices went almost nowhere, but it was just enough to get a record closing high in the S&P 500 and the Nasdaq 100. I'm talking today about distressed tech, though, so not even the Nasdaq 100. We're going to get to that in a second, but I just want to show you there is no more distressed tech than Chinese tech. These are our leaders year to date. I know there's a lot of funny symbols. A lot of these are ETFs, but if you just look up in the upper left, that is KWEB. That is Chinese tech, the internet ETF from Crane Shares. That is up almost 22%. After that is ARK, the ARK Innovation Fund. That's up 17%. And you take a look inside. Well, let's take a look at the Nasdaq 100. As I said, that was at a record high today. You're going to notice year to date, there's not necessarily a lot of participation among some of these big guys. You go over to the ARK components. All right, count out Tesla. That has not done that well this year on a net basis, but a lot of price action, a lot of outsized returns in here. So my point is we're seeing a lot of sideline tech just kind of exploding right now.
Well, it's interesting, I guess, while people might be taking on more risk in that sideline tech, they're also looking for safety.
Safety, why? What would that be? Dollar and the gold. So let's break that apart. We got the Global Fund Manager Survey from B of A today, and here's a question they asked investors controlling $500 billion in assets. What are the top currencies that investors expect to outperform this year? U.S. dollar is up top. That's 31%, but that is coming down from the high 30s. Japanese yen, that is rising. That is now 30% on the verge of taking over. Then we have gold. Yes, gold is a currency. That is getting 25% of the vote, and that is also increasing a lot. And I just want to show you what gold has been doing today because it closed at a record high, and we've seen gold closing at records pretty consistently. So I'm looking for GC equals F. It's up 11% this year, and here we go. Let's do the year-to-date chart, and you can see, there we go. This is today's close right here, good enough for a record. Very, very close, within $50 of 3,000. So gold making a comeback here. And I just want to point out one more thing. Who's buying gold? That would be the central banks. And I have, this is what central banks have been doing since 2010. It has been outsized the last few years. You throw a trade war in there, well, you got something interesting.
Oh, no wonder people are buying. Let's talk about other commodities as well. What are we seeing there?
So we got commodities are kind of mixed. I'm going to go back to our commodities heat map, and we'll just cycle through this fairly quickly. We've had some winners and losers. I would point out that this is the time in the business cycle when you tend to see commodities outperform. We've seen a huge run up in coffee. That's still holding on to gains of 25% this year. That's 25% right there. H&G is copper. That has been down the last few days. Let's put a 3-month chart or a 2-month chart on that, and we can see, there we go. It's not the picture I was looking for, but here we go. Here's the last 3 days, net down. So we've had some mixed action, but you take into consider everything that's happened. You know, it's not OJ. OJ has been absolutely dismal over the last year. You can see this just fell apart very recently. So a mixed bag with respect to commodities, but we get the Fed cut one more time or some inklings that the economy is turning just a little bit, but not enough to recession. I think we're going to see most commodities kind of explode to the upside.
Interesting. We'll see. And depending on dollar action,
it's all
too.
if, and it's a big bet with the Fed. So we'll see.
Oh, we got it.
Oh, yeah. Thank you. Thank you.
Hearing my ear fist bump cue. Stick around. We're asking for a trend on the other side. Occidental Petroleum and Devon Energy reporting their fourth quarter results. Oxy's adjusted earnings per share topping estimates. It also signed 2 divestment packs for $1.2 billion for the first quarter. Meanwhile, Devon Energy raising its quarterly dividend as company-wide production in the fourth quarter topped estimates. Here with more on the energy landscape, Tortoise Senior Portfolio Managing and Managing Director, Rob Thummel. Rob, it's great to see you here. So interesting to see these stocks trading how they are. I guess, you know, in a lot of cases, it's all about cash return. Is that why Devon's gaining here and we're not seeing the gains for Oxy? Just give us kind of your top level thoughts.
Yeah, it looks like it, Julia. So it looks like big picture in the oil and gas space right now, it's all about capital discipline. It's about returning cash to shareholders because most stocks, including these two you're talking about, Occidental and Devon, have high free cash flow yields, greater than 10%. You know, if you think about that, that's a pretty high free cash flow yield relative to the market. It's probably less than 5%. So these are always attractive stocks from that perspective. Today, or what's factoring today, it looks like that Occidental's capital spending might be a little higher than what the street expected. So we'll hear more about that tomorrow. Higher capital expenditures actually brings down that free cash flow yield a little bit for Occidental. So that's probably the biggest reason why you're seeing a little bit of after hours negative, I guess, performance on the Occidental stock relative to Devon. Is trading pretty well.
Oxy is down 18% over the past year, which is interesting given that this continues to be a favorite of Berkshire Hathaway and of Warren Buffett, who keeps adding to his stake in the company here. What's been behind that decline, and would you be following Buffett into those Occidental shares?
Well, I think it's paid off over several decades to follow Buffett. So, and you're right, he has been buying, and Berkshire continues to buy more Occidental. I think they're up to a little almost 30% ownership now. why is the stock decline? Well, the commodity prices declined a bit, and so you've seen commodity prices lower than probably where they have been historically, at least in the last few months. And so that's contributed to a little bit. Other reasons, there has been a little bit of a sector rotation out of the more cyclical, more commodity sensitive stocks, maybe into tech or maybe even into other areas of energy that are a little less volatile. And so I think that's why you've seen that happen. Look once again, Occidental is still a 10% free cash flow yield. It's got a little bit of a dividend yield, 2% dividend yield or so. It's lowering its debt, so it's still an attractive company to look at if you're looking at oil and gas companies and the opportunities going forward. I think what we've learned in the last maybe 5 years or so, that oil and gas is here to stay. It's going to be a significant part of the future if the global economy is going to continue to grow.
Well, and on that front, I also want to bring up Diamondback Energy, which is doing further expansion in the Permian Basin with a $4.1 billion acquisition of some more assets in that area. It's already the biggest exclusive Permian producer here. Is all of the Permian buying done at this point? Like, how much more can you move the pieces around?
Yeah, that's a good question, Julie. So you gotta like Diamondback Energy. First of all, for its ticker, it's a very interesting ticker. It's FANG is a great ticker. So, and I hope it stays around a while. But the reality is you're right. There are still some opportunities for consolidation. Exxon, Chevron, ConocoPhillips, Occidental have done lots of big deals in the Permian Basin over the last year or so, or last couple of years. And Diamondback so far has resisted and basically have been buying their own acreage. So what they're doing today and what they've done historically is effectively get a larger position asset base, basically. So buying acreage that's close to them or that's right next to their existing acreage. Why do they do that? Well, it's because it makes them more attractive to one of these larger players someday if a larger player wants to come in and buy a large acreage position like Diamondback has. Believe it or not, oil and gas producers are producing more oil and gas, but they're also continuing to produce oil and gas more efficiently. So they're lowering the drilling costs. They're lowering the completion costs. So all that means is the break even for oil and gas producers continues to go lower. That's a good thing, I think, in the grand scheme of things, in a world where the U.S. needs to produce more energy, the world wants more U.S. energy, but we need more low-cost energy to keep inflation low and keep commodity prices at a reasonable level for consumers.
Yeah, it seems like for these energy companies, it is a necessary thing to get those break-evens down if you've got a president telling you he wants you to produce more oil, Rob. Great to catch up with you. Hope to see you soon.
Thanks, Sheila.
For our chart of the day, we're taking a look at cash levels. Bank of America's Global Fund Manager Survey, it looks like cash is popular, right? Or not popular. I've got it backwards. Yahoo Finance's Alexander Canal. Set me straight, please.
Yeah, cash is not king, Julie. According to BofA's survey, cash levels have fallen to 15-year lows as traders double down on equities. So this signals a lot of bullishness surrounding stocks, the desire to really stay in this market. And this comes despite a lot of uncertainties out there. We have tariffs, inflation, other global trade risks. Typically those risks, that volatility, potentially push investors to keep some cash on the sidelines, but clearly not in this environment. So if we take a closer look at this chart, this is the level that fund managers have allocated to cash. We're sitting at just 3.5%. So this is the lowest level again since 2010. And that's driving up investor sentiment when it comes to equities and global growth expectations across the board. For where investors and these fund managers are putting some money to work, that's coming from, no surprise, big tech. BofA saying that long Magnificent Seven remains the most crowded trade according to this survey, followed by the US dollar and crypto. Of course, big tech hasn't entirely been the brightest star to kick off 2025. You're looking at the year-to-date gains and losses so far this year. Meta, the only Mag 7 name to outperform the benchmark S&P 500. We're seeing shares up around 22% since the start of the year. But with markets broadening out, yet another record high for the S&P 500 today, it's clear that bullish market sentiment remains intact. So if you have some cash, you're wanting to put it in this market, Julie.
Allie, thanks. Stick around, we got much more Asking for a Trend still to come. All 20 Formula One drivers and their 10 teams are in London tonight to kickstart the 2025 75th anniversary season with a new live launch event showing off each of the vehicles that will be racing this season. Joining me now, Yahoo Finance's own Prospermanian to talk to us about what to watch for.
Yeah, so Julie, for the first time ever, they're showing all these teams at the same time. This is, of course, the brainchild of Liberty Media, the owners of F1, kind of bringing the sport to the fans more so than before. Speaking of which, Ford, which is now joining F1 with Red Bull next year, invited new Red Bull driver Liam Lawson to meet fans at the Performance Center in Charlotte, where I was at. I had the chance to talk to him about joining one of the top teams in F1 and also taking on teammate and F1 world champion Max Verstappen.
As a driver, it's the biggest opportunity you can have going into a top team that's capable of fighting for world championships. It's obviously, as a driver, that's what we're here to do. So for me, it's a great opportunity.
With Max Verstappen now, your new teammate, obviously he's one of the best drivers potentially of all time on the grid right now. What is your mindset going into racing against a teammate like him?
I think it's more, to be honest, the opportunity of being alongside him. Obviously, everything in the team is shared, so our data between cars is shared. We come in from a session, we debrief together. The setups, between both of us are going to be shared as well. So, as a driver, to have him as a teammate, to learn off him, as much as he's going to be very, very hard to match, he's somebody that, if there's anybody that's going to be good to learn off, it's going to be him.
And most people who know Liam and Max Verstappen have seen the two on the popular Netflix show Drive to Survive. I asked Liam about that Netflix effect on the sport and the U.S. as well.
That's been really, really cool to show fans, I think, to anybody watching in before that. You didn't really get an insight. You saw what happened on a race weekend, and that was really it. So I think it's given a really good insight to our lives and to what the teams are going through. And I guess the amount of people, the amount of effort and work that goes on in the background. It's done really well. It's grown, especially in America. It's something that I spend a lot of time here now, and I can feel sort of it growing around and sort of people becoming really interested. And obviously we have more races here as well. So yeah, it's exciting.
Races in the U.S., Austin, Miami, and of course Las Vegas becoming marquee F1 events. And this goes hand in hand with U.S. F1 broadcasting rights, which Netflix, Amazon, and others are looking to bid on at the end of the year.
Well, and what's going to happen with the rights, and are there sort of front runners to get all of that?
So ESPN currently has the rights. I think it's $90 million a year. But reports suggest that they are actually going to not renew. And for whatever reason, thinking maybe the cost might be too high. And that's why the Netflix of the world, even NBC Sports, but also Amazon, looking at those rights, it would be a game changer for all these races to be online, as opposed to a hodgepodge of various local broadcasts across the globe. One sort of portal will be pretty interesting for Netflix or for F1. And then how much money are they going to get? It's going to be bonkers.
Well, we'll count on you to keep us updated on that. Should be fun. Thanks, Ross. That's a wrap on today's Asking for a Trend. Be sure to come back tomorrow at 4:30 p.m. Eastern for all of the latest market-moving stories affecting your wallet. Have a great night.